Welcome to The Explainer. Today, we're diving straight into what I like to call the macro machine. We're going to unpack some incredibly powerful quantitative strategies straight out of chapters 8 and 9 of 151 trading strategies. We are completely zeroing in on foreign exchange, or FX, and commodities. Now, these aren't just any asset classes. They're the cross-asset arenas where quantitative math isn't simply looking for tiny micro-efficiencies. Instead, it's the ultimate tool used to measure massive global forces. We're going to see exactly how quants use math to decode the overarching macroeconomic state of the world. Let's jump right in. Okay, let's dive into this. Here is our roadmap for today. We're splitting this into two main hemispheres. First up is foreign exchange, where we'll cover filtering trends, exploiting carry trades, and triangular arbitrage. Then we hit commodities to unpack term structure yields and pricing skewness. Section 1. Macro states drive markets, the state of the world. So before we get buried in the mathematical formulas, we really need to understand the sandbox we're playing in. When we talk about FX and commodities, we aren't just looking at isolated math problems, and we definitely aren't looking at individual company earnings like we would with stocks. We're looking at how quants measure the actual literal state of the world. We're measuring the gravitational pull of global central banks through interest rate differentials. We're quantifying the real-world physical supply and demand pressures for raw materials. And we're tracking the behavioral premiums of massive market players. In these specific asset classes, the macro state of the world absolutely dominates everything else. Section 2. FX. Filtering the trend, signal through the noise. If you've ever looked at a chart of FX spot rates, you already know they are notoriously noisy. They bounce around constantly. To actually find the signal in all that noise, quants use what's called the Hodrick-Prescott, or HP filter. Now, I know the math looks a little intimidating on screen, but let's completely de-jargonize it. The whole goal here is to physically separate the low-frequency trend signal, which we call S star, from the high-frequency daily market noise. The first half of this equation minimizes that noise, basically the difference between the actual spot rate and our smooth trend. The second half uses a smoothing parameter, lambda, to heavily penalize any wild, sudden jumps in that underlying trend. By minimizing this entire function, g, we strip away the erratic spikes and reveal the true fundamental direction a currency is actually moving. And this brilliantly illustrates how we can take a classic equity strategy and adapt it for the FX market. In equities, you might just slap a dual moving average strategy directly onto a stock price and call it a day. But in FX, our absolute first step is extracting that trend component using the HP filter. Only after we have that nice smooth S-star line do we compute our short and long moving averages. When the short moving average crosses above the long moving average on this filtered data, boom, that's a buy signal. When it crosses below, it's a sell. It's essentially a classic momentum strategy, but it's engineered specifically to handle the noisy reality of global currencies. Section 3. FX, exploiting carry trades. The forward premium puzzle. All right, moving from momentum over to yield differentials. To understand the carry trade, you first have to understand the theoretical rule that it completely breaks, Uncovered Interest Rate Parity, or UIRP. This formula represents the gravitational pull of global central banks. RD is your domestic interest rate, and RF is the foreign rate. Now, theoretically, if a foreign country has a much higher interest rate than your home country, their currency should automatically depreciate over time. Why? Because if it didn't, you could just convert your money, park it in their banks, soak up that massive interest, and convert it back for a totally risk-free profit. UIRP basically dictates that the exchange rate must shift to perfectly offset the extra interest you earned. In theory, there is no free lunch. But here's where it gets incredibly fascinating. The real world entirely contradicts the theory. As you can see from this quote, this anomaly is known as the forward premium puzzle. Empirically, on average, those high interest rate currencies actually do not depreciate to offset the yield. In fact, they often tend to appreciate. This massive empirical anomaly, a blatant violation of standard economic theory, gives quantitative traders an absolute goldmine of an opportunity. Which brings us right to the basic mechanics of the carry trade. You take a look at the forward FX rate and compare it to the current spot rate. If a currency is trading at a forward premium, meaning the forward rate is greater than the spot rate, you sell it. If it's at a forward discount, meaning the forward rate is lower than the spot rate, you buy it. You are essentially borrowing the low interest rate currency to invest in the high interest rate currency, capitalizing on the fact that the textbook depreciation simply doesn't happen fast enough, or honestly, at all. And quants, of course, don't just do this with one random currency pair. They scale it up into two major strategies. First, we have the high minus low carry. This is a cross-sectional portfolio. You calculate the forward discount for a whole basket of currencies, right? Then you go long on the top quantile, the ones with the very highest forward discount, and you short the bottom quantile. It ends up being a zero-cost, dollar-neutral portfolio. The second strategy is the dollar carry. Here, you take the aggregate average of the forward discount across all your foreign currencies. If that average is positive, you just go long on all of them against the US dollar. Interestingly enough, empirical evidence suggests this aggregate strategy acts as a massive macro bet on the overall state of the US economy. When the US economy is weak, that average forward discount tends to flip positive. Section 4. FX. Triangular Arbitrage Speed, the HFT game. Okay, we are going to dramatically change the pace now and step into the ultra-fast world of high-frequency trading. This strategy relies purely on absolute execution speed, not long-term macro trends. It's a literal physical loop across 3 currency pairs. Step 1, you take currency A and exchange it for currency B at the current bid price. Step 2, you immediately take that currency B and exchange it for currency C. Step 3, you close the loop instantly by exchanging currency C right back into currency A, but this time paying the ask price. Now, for this to actually work, the math on the round-trip calculation has to be flawless. The bid of A to B times the bid of B to C divided by the ask of C to A must be strictly greater than 1. If it's greater than 1, congratulations, you've just created risk-free money out of thin air. But as you can guess, these mispricings are incredibly ephemeral. We're talking fractions of a second. This game isn't about predicting the global economy. It is entirely an arms race of technological speed and low-latency market data. Which brings us to a really pivotal transition. We've seen how interest rates and sheer speed govern fiat currencies. But what happens when the asset isn't just a digital number on a screen? What happens when it's real oil in a barrel, or wheat sitting in a silo? How do macro states influence physical assets differently? Section 5. Commodities. Term structure yields, contango versus backwardation. Welcome to the commodities hemisphere. Over here, physical supply dynamics are the real boss. What's really fascinating is how simply defining a ratio allows quants to build massive, cross-asset portfolios based strictly on the shape of the futures curve. We define the phi ratio as the price of the front-month futures contract divided by the second-month contract. If phi is greater than 1, the market is in backwardation. That means near-term physical supply is tight, so the front month is way more expensive. This actually generates a positive roll yield for long positions when you sell the expiring contract and buy the cheaper next one. On the flip side, if phi is less than 1, we're in contango. There's plenty of supply, storage costs are eating you alive, and long positions suffer a negative roll yield. Quants exploit this by building cross-sectional portfolios, simply buying the commodities with the highest phi and shorting the ones with the lowest. But, we can look a lot deeper than just the prices. We can actually look at the specific players in the market using hedging-pressure. The CFTC publishes this amazing weekly Commitments of Traders report. It tells us exactly what the commercial hedgers, the actual companies farming the wheat or drilling the oil, are doing versus the pure speculators. Strategy 6 is brilliant because it pits the structural real-world needs of those hedgers against the behavioral momentum of the speculators. You go long on commodities where hedgers are lightly positioned, so the bottom quintile of hedger pressure, but where speculators are aggressively long, and then you short the exact inverse. It's a mathematically precise way to trade on pure market positioning. Section 6. Commodities, Pricing, and Skewness. Behavioral Premiums. In our final section today, we're looking at behavioral premiums and theoretical pricing. Strategy 7 exploits what's called the skewness premium. We calculate the historical skewness of futures returns, and empirically, quants have observed a really strong negative correlation between high historical skewness and future returns. Think about it like this. If a commodity has a massive positive skew, meaning it has a history of sudden, crazy price spikes, retail traders tend to overpay for it. It's like buying a lottery ticket. Because of this behavioral premium, the smart strategy is to build a zero-cost portfolio where you go long on the bottom quintile by skew, the boring, steady commodities, and you aggressively short the top quintile, the lottery tickets. Finally, strategy 8. How do we theoretically price a physical commodity? quants heavily rely on the Ornstein-Uhlenbeck process. Let's de-jargonize this really quickly. It's a physical model for mean-reverting Brownian motion. Unlike a tech stock, which can theoretically just go up forever, physical commodities have a hard cost of production. If prices drop too low, producers literally stop drilling or mining. If prices go way too high, everyone rushes to produce more. Because of that, log spot prices naturally snap back or mean revert to their actual production costs. The parameter kappa in this formula represents exactly that, the aggressive speed of that mean reversion pulling back toward the long-term average A.
By solving that continuous time process, quants can derive the exact theoretical futures price. And once you've got that math nailed down, the trading strategy itself is wonderfully simple. You just trade the spread. If the actual market price drifts way too high above your Ornstein-Uhlenbeck model price, you short it. If it drops too low, you buy it. You are betting heavy that the immutable laws of physical production and mean reversion will inevitably pull the market right back into line.
So here's the absolutely crucial takeaway. We've traveled completely through the macro machine today, from the interest rate gravity of the FX carry trade all the way to the physical supply constraints of commodity term structures. We've seen exactly how math isolates trends, exploits our behavioral quirks, and models physical reality. But I want to leave you with one final provocative question. By mathematically exploiting all these macro anomalies, do quantitative strategies actually create market efficiency, or do they simply profit from its inevitable, constant absence? Thank you so much for joining me on this explainer. I really hope this sparked your curiosity to look at global markets through a completely new quantitative lens. Catch you next time.